Example portfolios. Let's look at a BMO Smartfolio portfolio as an example. After all, it's been built by a team of professional portfolio managers. Here's the long-term growth portfolio. We see that the overall target asset allocation at this point in time is 76.4% equities and 23.6% fixed income. We know that the more equity exposure we have, the more volatile the portfolio will be, but it will also have a greater potential for growth. Conversely, the more fixed income we have, the more stable the portfolio, but with a lower potential for growth. But if we look one level deeper, we see that our equity portion is diversified around the world. We have exposure to Canadian stocks, US stocks, international stocks, and emerging market stocks. International stocks refers to equities from developed countries outside of Canada and the US, while emerging markets refers to equities from less developed countries that might have more risk and potential return than developed countries. Similarly, the fixed income holdings are diversified across corporate bonds and government bonds. Just like stocks, bonds can have varying levels of risk and return. Generally, government bonds are the safest and lowest returning bonds. Corporate bonds tend to be riskier and offer the potential for more return. That's because borrowing money from a corporation is generally riskier than borrowing money from a developed nation's government. The likelihood of a corporation not being able to pay back its bondholders is higher than for a government like Canada or the United States. If we look at a more aggressive portfolio like the BMO Smartfolio Equity Growth Portfolio, we see it had a 93.9% target equity exposure and 6.1% fixed income exposure. These two portfolios give us a good look at how different levels of risk can look and feel for an investor.